Intuitive Surgical just delivered the kind of quarter investors usually want to see. Revenue beat expectations. Earnings beat expectations. And demand for robotic surgery remained strong. Yet the stock sold off. And that is where the real story begins. Because the market may be focusing on the wrong question. Is Intuitive Surgical losing momentum? Or is the market simply demanding more from a company that has spent decades building one of the most powerful ecosystems in medical technology? The United States may be becoming more mature. But robotic surgery is still expanding globally. Da Vinci 5 is accelerating the next upgrade cycle. The installed base continues to grow. And Ion is opening a second potential growth engine. So the question is not whether Intuitive Surgical is still a great company. The question is much more important. Is this sell-off telling us that the robotic surgery story is breaking? Or that the next phase of the story is only beginning? The market reaction was brutal. Intuitive Surgical delivered another strong quarter. Revenue continued to grow at a double-digit rate. Earnings beat expectations. And the company maintained a strong outlook for procedure growth. Yet the stock sold off. Why? Because with Intuitive Surgical, good is no longer good enough. Investors are not simply asking whether the business is growing. They are asking whether growth can continue to accelerate. And when expectations become this high, even a strong quarter can trigger a sell-off. But this creates an important question. Is the market reacting to a genuine deterioration in the business? Or simply to growth that is no longer exceeding already extreme expectations? This is the question investors are asking after the sell-off. Is Intuitive Surgical finally losing momentum? The concern is understandable. Procedure growth in the United States has started to moderate, while expectations for Isrg remain extremely high. And when a company is priced for near-perfect execution, even a small slowdown can trigger a major reaction in the stock. But here is the problem with that narrative. The United States is already the most mature robotic surgery market in the world. So a slowdown in one market does not automatically mean that the entire robotic surgery opportunity is slowing down. The more important question may be: is Isrg losing momentum? Or is the next wave of growth simply coming from somewhere else? Here is where many investors misunderstand Intuitive Surgical. The robot is not the business. The robot is the entry point. Once a Da Vinci system is installed in a hospital, the economic relationship does not end with the initial sale. Every procedure requires instruments and accessories. Surgeons become trained on the platform. Operating room teams build workflows around it. And as utilization increases, the recurring revenue opportunity expands. This creates a business model that is fundamentally different from simply selling expensive medical equipment. The real question is not: how many robots can Isrg sell this year? The real question is: how many procedures can its growing installed base perform over the next decade? And this is where the compounding effect begins. Every new Da Vinci system expands the installed base. But the value of that system is not limited to the day it is sold. As utilization increases, more procedures require instruments and accessories. More procedures also create greater familiarity among surgeons and operating room teams. That can strengthen the platform over time. And with more than 11,000 Da Vinci systems already installed globally, Intuitive Surgical is no longer building its ecosystem from zero. It is expanding an existing network. This is the hidden power of the business model. Every new system can create not just today's revenue, but a larger platform for tomorrow's recurring revenue. But now, Intuitive Surgical faces an important test. Can it continue expanding inside the installed base it has already built? That is where Da Vinci 5 becomes critical. The fifth-generation platform is not simply about selling a new robot to a new hospital. It also creates a potential upgrade opportunity across an existing global ecosystem. And that changes the growth equation. Intuitive Surgical no longer needs every new dollar of growth to come from completely new customers. Some growth can come from existing hospitals upgrading their technology. The opportunity is significant. But the real question is whether Da Vinci 5 can successfully accelerate the next replacement and upgrade cycle. Because the next phase of Isrg's growth may come from the customers it already has. This is where the competitive moat becomes much more difficult to replicate. The moat is not simply the robot. It is the workflow built around the robot. Surgeons must be trained. Operating room teams must become familiar with the system. Hospitals must integrate the platform into their procedures. And over time, clinical experience accumulates. This creates friction for any competitor trying to replace the system. A competitor may be able to build a robotic arm. But building the ecosystem around that robotic arm is a much bigger challenge. And that is why the real competitive battle in robotic surgery may not be about who builds the best robot. It may be about who becomes embedded deepest inside the operating room. The competition is coming. Large medical technology companies are investing heavily in robotic surgery. And eventually, hospitals will have more alternatives. That is a real risk for Intuitive Surgical. But entering the market is not the same as breaking the moat. A competitor can build a robotic system. But it still needs to convince surgeons to change their workflow. Hospitals to invest in a new platform. And healthcare systems to trust that platform with complex procedures. That takes time. So the question is not whether competitors can build robots. The question is whether they can build an ecosystem powerful enough to replace the one Intuitive Surgical has spent decades creating. And that is a much higher barrier to entry. This may be one of the most important parts of the Isrg story. The United States is the most mature robotic surgery market. So naturally, growth there will eventually begin to moderate. But that does not mean the global opportunity is reaching maturity. Across international markets, robotic surgery adoption is still at very different stages. Some hospitals are only beginning to adopt the technology. Some surgeons are still being trained. And many healthcare systems have yet to reach the penetration levels seen in the United States. This creates an important distinction. A mature American market does not necessarily mean a mature global market. And for Intuitive Surgical, the next wave of growth may come from markets that are still at the beginning of their robotic surgery journey. But Da Vinci is not the only platform investors should be watching. There is another part of the Intuitive Surgical story that could become increasingly important. Ion. Ion targets a different opportunity: robotic-assisted bronchoscopy and the diagnosis of pulmonary nodules. And its growth rate remains significantly higher than the overall Da Vinci business. That is important because Ion is still much earlier in its adoption curve. The platform is smaller today. But that also means the potential runway could be much longer. If Intuitive Surgical can replicate even part of the ecosystem it built around Da Vinci, Ion could become more than a niche product. It could become the second growth engine investors are currently underestimating. And this is where the current market narrative becomes interesting. Investors are heavily focused on one question. Is procedure growth slowing? That question matters. But it may not tell the entire story. Because Intuitive Surgical is simultaneously expanding its installed base, introducing Vinci 5, growing internationally, and developing Ion as a second platform. So the business is not standing still while the market debates one growth rate. It is continuing to expand the ecosystem. And that creates a potential disconnect. The market may be measuring the speed of the current engine, while overlooking the engines that could drive the next phase of growth. But a serious analysis of Intuitive Surgical cannot ignore the risks. The biggest risk is not one weak quarter. The real risk is structural. What if procedure growth slows for several years? What if hospitals delay capital spending? What if competitors finally offer robotic platforms that are good enough, and significantly cheaper? And what if healthcare systems become more focused on reducing procedure costs? These are questions investors must take seriously. Because a powerful ecosystem can create a moat. But a moat is not a guarantee. The competitive advantage Intuitive Surgical built over decades must continue evolving, because the competition is evolving too. And this is why the competitive battle in robotic surgery may be misunderstood. The future will not necessarily be decided by which company builds the most advanced robot. Hardware is only one part of the equation. The real battle is about the entire ecosystem. Surgeon training, clinical data, hospital economics, software, workflow integration, and the number of procedures performed on the platform. A cheaper robot may attract attention. But attention is not adoption. And adoption is not the same as becoming deeply embedded in the healthcare system. The real battle is not robot versus robot. It is ecosystem versus ecosystem. And this brings us to the bigger picture. Intuitive Surgical may be entering a new phase of its evolution. The first phase was about proving that robotic surgery could become a standard part of modern medicine. The next phase may be about expanding the ecosystem around that platform. Vinci 5 can support a new upgrade cycle. The installed base continues to grow. International markets still offer significant room for adoption. And Ion could provide another long-term growth opportunity. So the question is no longer simply whether Intuitive Surgical can sell more robots. The bigger question is whether the company can continue expanding the number of procedures, surgeons, hospitals, and medical applications connected to its ecosystem. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.